valuation, it's a stock valuation, right? It's a very fuzzy concept. It's a very concrete concept in one sense, but on the other sense, it's a very fuzzy concept. I'm not sure whether I'm able to communicate myself. How do you look at valuation and preferred matrix? And there are so many P ratios, DCFs. So just talk about how you value the stocks.
Right. So there is this concept of triangulation. So
Okay.
when you have we have a company, and the job of valuation is to determine, okay, how much do we pay for this company so that we get good returns from this investment over time. And generally, when you have a complicated thing that you want to estimate, it's generally a good idea if you have multiple methods of doing this, and they all arrive at somewhat the same answer. If you come at the problem in several different ways, and they all sort of give you roughly the same answer, then you're generally much more confident that your valuation is not too far off the mark. And so this comes from GPS satellites. So when your iPhone is trying to ping a bunch of GPS satellites and find out where it is, it takes data points not just from one or two satellites, but it tries to take at least 4 or 5 satellites at a minimum, and it uses the information from 5 different satellites to triangulate its position, even though we are all living in 3-dimensional space. So 3 satellites would be enough to find the information, but the iPhone typically contacts say 4 or 5 different satellites, so that it has a higher degree of confidence and lower error in the estimate. So valuation is something like that. So you come at it from multiple different angles, and if you're able to, if they all give you roughly the same answer, then you're reasonably confident in your valuation. So there are a few ways to approach this. One is the DCF, as you mentioned, the discounted cash flow method. So basically, for those who are not familiar with the method, who are listening to your podcast, so you predict the future cash flows of the business, and then you discount them at the return that you want. So if you want a 10% return on your investment, basically what you do is you try to predict the cash flows of the business between now and basically forever from now, and then you discount them all back to the present using a 10% per year discount rate, and that will give you a value for the company, and that is how much you can pay for the company today if you want that 10% return from that investment. Now, the problem with the DCF is that it's very, very, very sensitive to the future cash flows of the business, as well as to the discount rate. So you change the discount rate a little bit, you change a few small things about the assumptions. Instead of assuming that the business will grow at 10%, suppose you assume that the business will grow at 12%. And suppose instead of assuming that the business will grow for 15 years, you assume that the business will grow for, say, 25 years. When you change your assumptions like this, the result of the DCF is it changes completely. The DCF is very, very sensitive to these assumptions. So one way to sort of get around that is to use this technique called the reverse DCF. And what the reverse DCF does is it looks at what the price of the company is today in the market. So if you just want to buy the company today, how much do you have to pay for it? And then the reverse DCF tries to find out, okay, fine, if I assume that today's price is correct, then at what rate should the company be growing at? So if it grows at 10% for the next 10% a year for the next 15 years, then does that justify the market price? If it grows at only 5% for the next 10 years, then how much is the market price overstating things? So the reverse DCF is basically you try to look at the market price and you try to figure out what assumptions are baked into the market price. So for example, if you've come to the conclusion that, okay, the market price, the market thinks that this is a business that will grow at 10%, but I know for a fact, or I know with a reasonable degree of certainty that this business is going to be growing at 20%. So then the market is undervaluing the business, right? Because the market is assuming that it will grow at 10%, whereas I am reasonably confident that it's growing at 20%. So that way, I can come to the conclusion that the market is undervaluing the business without knowing precisely what is the correct valuation to assign to the business. So the business may grow at 20%, or it may grow at 15% or 18% or whatever. I'm not really making a very exact prediction on that. But I'm reasonably confident that whatever rate the business grows at, the market is undervaluing the business. So the reverse DCF helps you think about valuation from this perspective, where you don't have to be exactly precise, as long as you have a decent margin of safety. So that is one way to value the business. Then there are other ways. So there is you can try to predict what the earnings of the business will be in the future conservatively, and then you can assign a multiple to that. So you can say, okay, today the company is earning $10 a share, but I think the company will earn $20 a share 10 years from now. So the company will roughly grow at 7% a year for the next 10 years. So it will be earning $20 a share 10 years from now. And I think the market will assign a multiple of 20 to that. So now $20 a share times 20, I think the market will value this business at $400 10 years from now. So what is the company trading at right now? If it's trading at $100 right now, then I think I will quadruple my investment in 10 years. And if I quadruple my investment in 10 years, that's a 15%, roughly 15% rate of return. So you can do something like this, but that involves sort of estimating what the market will be willing to pay for this business 10 years down the line, and that is kind of anybody's guess, really. But if you make reasonable assumptions, if you make conservative assumptions about the future cash flows of the business and the future multiples at which the business will trade at, then you can arrive at a decent price to pay for the business today. And if the market price is less than that price, then you might have a reasonable investment candidate on your hands. So that's one way to value the business. Then of course there's this price to book and price to earnings and price to free cash flow and all these different EV to EBITDA, and there's a whole bunch of different ratios that you can look at, which ratio is the best for a particular business. That really depends on the nature of the business and the capital allocations going on inside the business and things like that. So for different businesses, you can look at a bunch of different ratios and come up with a valuation that way. Then there's also this thing that people love to do called the sum of the parts analysis. So you take a business, the business may have 5 different parts to it. You value each part individually, and then you add up the values, and hopefully you get something close to the value of the business. So that's one way to value businesses. So basically, there's a whole bunch of techniques you can bring to bear. And if they all give you roughly the same answer, or if they all tell you that the business is definitely undervalued, or not definitely, but likely undervalued in the market today, then those different valuations sort of support the same conclusion, and you can maybe look at taking a position, assuming you have a decent margin of safety. So valuation, to your point, is also a bit of both art and science.
So it's basically, I think, looking at the multiple valuation matrices and kind of get a feel of whether the business is worth investing or no. I mean, very difficult to kind of get into a very mathematical sense, going by one formula and deciding on that thing, isn't it?
Right, absolutely. So Charlie Munger calls this physics envy. So people like physicists, they like to have very precise formulas for every little thing. If you have an object, and if you have a projectile, it's projected at a 30-degree angle, then how far down the road will it land? And they have a precise formula to calculate that. Valuing a business, unfortunately, is not like that. And it's generally not a good idea to expect to have precise formulas for the values of businesses. But if you adopt various approaches and you try to triangulate on the value of a business, with some businesses you may get completely different results. So the sum of the parts valuation may tell you that the business is worth $10 billion, but then if you do a DCF with some assumptions, you may get the value of the business as $1 billion. Now that's a 10x difference, and you can't really do anything with that. But for some businesses, you may be able to triangulate to within a reasonable margin of error, and if the market price is much lower than a conservative estimate of the value, then you don't really have to precisely value the business, because you know that even if you could precisely value the business, the value you would get would be significantly higher than the market price today. And if you know that, that you may be able to make an investment decision just based on that, without having a very precise sense of what the business is worth.
Yeah. And what do you think about these, analyst estimates? There is a market consensus. There is a Goldman Sachs coming out with something. There is a, Morgan Stanley coming out with something. What do you think about following those estimates?
Well, I'm sure some of them are right some of the time.
Okay. Yeah. Yeah. I mean, because for an average investor, spending so much of time valuation triangulating, just trying to look for an alternative. What could be the easy alternative for them to because these market consensus numbers are out, right? They're public. And
well, some analysts are very conscientious, and they take a lot of pains. They are very skilled, and they may be able to analyze businesses well and value them well. Other analysts, not so much. So now, instead of valuing a business, you now have to value an analyst. you have to decide who is a good analyst you're going to listen to, and who is not a good analyst. And also, analysts have a lot of incentives. So for example, a company, the analyst may be working for a company, an investment bank or something like that. And the investment bank may be doing so much of business with a particular company. So if a company wants to raise debt or raise an equity offering or something like that, they may be working with the investment bank. Now you have an analyst who's working at this investment bank. Now the incentive for the analyst may not be to downgrade the stock or something like that, even if the analyst feels that this is not this stock is going to underperform the S&P 500 or something like that. The analyst may not be in a position or he may not have the right incentive structure to come and say that out. Simply because the incentives are not there. I generally don't look at analyst estimates or anything like that. I think it was Morgan Housel who has this famous line, and he says, when you say a company beats expectations or a company misses expectations, it's not the company missing the analyst estimates. It's actually the analyst estimates missing the company's results.
Yeah, I wonder that time, because there's a beats, there's days, and there's a lot of drama around things, which, if you have a time horizon of 5 to 8 years, I'm not sure how much that matter. I mean, I'm sure Amazon would have missed, or Netflix would have missed their estimates so many times, but they have been a monster of the stocks, and over a period of time. So I would
right.
trust
over long periods of time. One or two quarters don't make or break an investment thesis usually.